experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors because your success is our business.
Success.
Yes,
Our experience over
securities,
the last decade
empowering
has
tomorrow,
been
has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. Welcome to Yes Securities, where we don't just secure investments, we secure your future. In the ever changing landscape of finance, one thing remains constant: the need for a reliable partner. At Yes Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors because your success is our business. Yes, Securities, empowering tomorrow. Welcome to Yes Securities, where we don't just secure investments, we secure your future. In the ever changing landscape of finance, one thing remains constant: the need for a reliable partner. At Yes Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors because your success is our business. Yes, Securities, empowering tomorrow.
Hello everyone, welcome to our second session of Yes FinPulse, a brand new webinar series crafted to dwell into the intricate technicalities and broader financial discussions. At Yes Securities, we believe finance should empower, not intimidate. Over the past decade, we have evolved into trusted advisors guiding both individuals and institutions. Now, without further ado, let's dive into the heart of the matter. Our crucial inquiry for today: how to avoid landmine in investing. And joining us is our esteemed speaker, Mr. Ravindra Bhandari, is here to share his insights. Before we start, let's briefly ruminate on our preceding session. Last Wednesday, we had the privilege of hosting the second segment of our trend following with the moving averages webinar. I trust you found that session as enlightening as I did. Please join me in extending a warm welcome to Mr. Ravindra Bhandari, a luminary in Indian financial sphere with over 15 years of seasoned expertise. From investment banking to corporate investment relations, Ravindra's insights are both profound and pragmatic. Armed with, armed with an MBA in finance and adorned with a prestigious certifications such as CFA and FRN, Ravindra's reservoir of knowledge is truly invaluable. Today, he graces our platform to guide us how to maneuver investment risks. And here's the cherry on top. In case you happen to miss any of our sessions or wish to revisit the pearls of wisdom we shared, fret not. We'll be archiving the entire series on YouTube under the playlist Yes Pimples, ensuring you can catch up at your leisure. Also, in today's session, we'll have interesting quizzes during the webinar, so please be alert and answer the questions. Let's begin. Over to you, Ravindra.
Hello everyone, and thanks for sparing time to join this session. Today's session, I thought of talking about different behavioral aspect of investing, and that's why we chose this topic of how to avoid landmines during investing. Why avoiding landmines is important in the field of investing is you enter into the arena of investing because you heard from your family, friends that they are making tons of money in the capital market, and then you also want to participate in that kind of wealth building exercise. So our idea is in the process of finding that gold mine, you shouldn't step on any kind of landmines which can take your journey backward in terms of wealth creation. So we thought about talking about few of the things which impact us behaviorally when we are investing. Look, the investing the market, it is governed by basically two most important behavior. One is, as everyone will say, one is greed and another is fear, and that thing hasn't changed in last 100 years. The similar thing were true if you look back the art of investing, say in India it is not prevalent 100 year back, but if you see a developed market like US and all, these were prevalent there even the 100 year back. The same greed and fear used to drive the investing methodology. Why this is important? Greed is something like you extrapolate the return which you have generated in a short span of time or with a small capital, and you want to generate that for a larger time frame or for a larger capital. Something like if you have generated, say you have invested 10 lakh rupees and you have made a return of 20% in 1 year, and you feel very happy about it. Now you want to do the similar thing with the capital which is 5x 10x of that size, so that the quantum of return, the quantum of profit which you can generate from there is significantly higher, and it impacts you materially on your financial success. That's the greed side of the story. The fear side of story says that whenever there is extreme fear in the market, when the people are running away from capital market in terms of protecting their capital, that is the fear side of story. What we are going to discuss is you shouldn't be overextending your greed in the market so that you make your decent return without taking exceptional amount of risk. Before talking about behaviors, let's for a moment think about what can drive the greed. At least, say in Indian equity market, if I talk about the large cap, the last 10-year return would be something about 13% on a Nifty 50 level, the large cap indices. And over on top of that 13%, we got some dividend of 1.5%, so 14.5%. Even after adding last 2 year bull run, so we have made a 14.5% kind of average return for last 10 years. If we go to mid cap and small cap, what will happen? You will add 200-300 basis points extra to that return. What normally happen when greed psychology gets you is, say you have generated 50-60% return in last 2 years, and now you tend to believe that this kind of return can be easily achieved for a longer time frame. This is the greed psychology, that you have made a decent return for a smaller time frame, but you think that for a larger time frame also this is very much easily possible, which is not so. Larger time frame, your return expectation again, as we say, revolves around the earning profitability growth of the country. Some investors even if I talk about the legendary investor, they will say that act greedy when the market is fearful, and act fearful when the market is greedy. What it means is, say if I recall few of the instances when the market was very fearful. One which very easily come to our mind is something when COVID hit us. So a couple of months after that March 2020 fall, there was huge amount of fear gripping nature among the investor, and they were shying away from the capital market. If you would have invested in those kind of market when the market overall is living in a hurry, there is ample scope of return opportunities which are easily available for investors. Similarly, if you have pick up a few of the decent names, say if I talk about few of the other crises, something like ILFS has happened in India in 2018. If you have picked up decent NBFC during that time, that was time the market was very fearful about the NBFC space. So any banking sector or NBFC companies which have been taken there, they delivered decent return. Before that, 2016 was a kind of very fearful for metals when we had a huge amount of dumping from China. The market was very skeptical about metals. All those metal company which we are seeing flying right now, they were available at zero point 0.5, zero point 0.6 book value. Some of the leading name were say Vedanta, Hindalco, Tata Steel. Everyone was available one fourth of the price, even not one fourth, much lower than the price at which they are available today. So, and if we move back further, is the classic case when after 2008 2009 for next 1 year the market was in doldrum, and no one was coming back in hurry in the market with a truckload of cash to buy. So if we pick up the instances where there is huge amount of fear among the market, fear may not be for the entire market as such, but fear can be available in some pockets of market. So you can choose your pocket where there are fear, and there is decent case of change of business cycle. Look what happens in equity market now. Everything works in cycle. Either it can be a business cycle which moves up or down the EPS, the profitability of the company, or it can be the cycle of sentiment where P ratio on which we value any company or different valuation methodology, they will be moving in cycle. The perception of those companies, whether to be on the bullish cycle or bearish cycle, that also changes with time to time. So in a bearish cycle, the companies which will be available at 10 15 p multiple or 20 p multiple, in a bull cycle that will go to 50 60 or even higher on the business where EPS and or there is a cycle of perceiving the market, and the P ratio, the bullishness or the bearishness will be reflected by that. Or what landmines or what mistakes one should avoid while acting on a capital market. Those are the things I wanted to discuss today. Say one thing is clear, in equity investing in capital market you will make mistakes. So don't fret too much about if there has been a wrong call or there has been some mistakes in the market. The only thing is making mistakes is okay, but you should be always worry about making fatal mistakes, something where the downside is so large that it throws you out of the market. Making mistakes is fine, it's a learning process. Even someone who has spent 40 plus years in the market, they will say that we continue to make mistakes and learn from it. The only idea for seasoned investor would be you shouldn't be making mistakes where where the impact is fatal and you are thrown out of the market. So how to overcome this kind of situation, this kind of behavioral aspect is, you buy bite size of your investment shouldn't cause any kind of indigestion. On a lighter note, that you should bite what is easily digestible to you. You shouldn't have a very high allocation to a single idea, so that you have a sleepless night when the ideas is not working for a particular time frame. Look, what happens is, all these things which we are discussing, this level of maturity in the market comes along with time. The problem with someone who is starting new in the market hasn't seen that growth period. Once you see few drawdown period, you will say that making losses, small amount of losses, drawdown time when your ideas doesn't work, it's fine. This is the thing which you have to embrace. When you invest professionally, but or you seek professional guidance, what happens, they ensure that if error is there while investing, the impact of error is not fatal. And to put it in a way how we not and put it advice to any person, any professional person in the financial market is, one way of tackling the situation is how you diversify. So what I'm trying to explain is, suppose if you're investing on your idea itself, and is amazing, something is really good for investment, don't over allocate to a single idea. It might be a very good idea, but sometimes what happens, it takes time for the market to understand that idea, and by the time you would become restless. So all those things will come into play if you have allocated into a single, something like if you have invested 50% of your investable capital in a single company, it doesn't respond, or the price doesn't move as per you in your favor for next 2-3 months. So that way, diversification will always help you in terms of avoiding the land. No scientific rule, but something like you don't allocate more than 10-12% a single idea. Again, on this, there's no scientific, but say a mutual fund also will put in a idea into a single idea. So that cap of 10% that you have a few ideas and then a different level of allocation towards it, and don't over allocate to a single idea. Something what happens is, if you are allocating to a single idea and it doesn't work for a small period of time, then you might get discouraged. Eventually your idea, since you have over allocated, your emotional aspect would be very high compared to what financial intelligence you have applied to that idea. So having a moderate allocation is one that you doesn't have a sleepless night over there. Second thing is, what professional people do is, they die by having a number of ideas which and number of stock or industry in the portfolio very closely correlated. When I say that, what happens is, say if you have only 5-6 stock in your portfolio, it might be related to one or two sectors which understand very well. But the thing is, the exception about that has to be on a favorable side. So seeking professional help helps in the sense that they will identify the larger sectors, larger universe, and since they keep a gauge on all the sectors which are, they will be able to help you in terms of riding the right sector instead of waiting for the sector to perform for you. All professionals ideally diversified portfolio. Within the portfolio, they will say you have different asset classes, which is equity, debt, and some kind of gold or real estate. And within equity also, there people say that you have at least gold, say 15, 20 stocks in your portfolio from different, so that you don't have to wait for, if you're only in one sector, then you invested in 2 3 sectors, then you have to wait for the second sector to get the favors from the market. You have to allocated among 15 20 companies, of diversification in portfolio, diversification investor like Peter who have made beat the market with 1400 stocks as well. And there are few investors who have beat the market with stocks very constant, something like 5 6 bet at a time, and they made huge amount of return in the market. Trying to say is that to reach that stage where you are making very concentrated bet, I think you should have invested 8 10 years in the market, and then you can play that kind of strategy, that I understand the cycle of the market, I understand the companies where I'm investing, I can take. But the first decade of your investing, I would say that you have a decent diversification strategy. Even more importantly, when you are with investment, the thing is, as I already saying, world of investing, making mistakes are fine, but you shouldn't, that is fine, you shouldn't be negative in nature. How to avoid that is, say we also sell financial service, we also sell professional services in the world of investing. Something like you invest 80% with the professional guidance, and 20% you try it with your investment strategy, your own equity investment ideas, and evaluate for a few years how you are performing, or how, and evaluate for how the professional fund is performing, and then you can take your final call, that whether I should be managing my money myself or continue to seek professional advice. Why I'm reiterating this, because maturity of investor takes many cycle to come. So initially it is advisable that you take professional help while investing. Other thing is, when I was talking about you should be minimum investing a decade, 8 10 years in the market to fully start investing on your own. What happens is, say the beauty of, say, investing is everything works in the bull market. The beauty of your investment will reflect when it is a bear market. This is, say, this has been true for a very long period of time, that in bull market what happens is all kind of ideas work, but the beauty of your selection will get reflected when it's a bear market. Relative preference will be outdated when it's a bear market. In bear market, your perform the indexes. So what I'm trying to say is, in a bear market, stocks and the portfolio which you have created, if market is down by 20%, your portfolio should be down by 10%. In that scenario, what happens, you have already created an alpha of 10%, and when the market makes an upswing, that will show you have saved huge quantum of capital, which can be deployed during good times. But if you're only benchmarking your performance in the bull market, I would say that it's a very short term time frame we are selling. Ideally, what we say in the world of investing is you should at least see 3 bear market. There's a joke around this. What we say is, in the first bear market, whenever you will have a downturn in your portfolio, you would, first time you see the downturn in the portfolio, you would say that, okay, my selection was right, but what happened is something was decided by the Fed, some changes of policy in the government, and hence my stock went down. That's how you cheer yourself up when the first bear market hit you. Second time, when this thing happened to you, you will say that, okay, I was ready to switch, I was ready to make these changes in the portfolio, but I heard this one from this personal guy, my friend guided that we should stay with this kind of stock. And hence you will find an excuse how you were dealing with the second bear market. During the third bear market, you will say, okay, boss, these are the things which will continue to happen in the market. These are the things, the volatility will continue to be there in the market. In equity, we make outsized return because we embrace that volatility. Say, if you invest in a less volatile instrument, something like debt or something like that, you might make that 8-9%. The reason is the return expectation is not that volatile as it is in the equity market. In equity market, we switch from that 8-9% is by embracing that volatility. We are happy with that volatility. There would be a time when the market will work in your favor. There would be a time when market will not work in your favor. So embracing that volatility makes you a better investor. Other thing, behaviorally, what I wanted to talk about, how to avoid landmines in investing is, what happens is sometimes we read about a new company and we are overblown with the idea and the return potential it can generate. In this kind of scenario, what happens is, you immediately see what is the capital appetite for yourself and you invest a large chunk at the very first go, or after very 1 or 2 months of the reading about that company. The idea is the conviction about investment is always built on tranches. So it's if the conviction has been built, or personally investing, the thing is, you should, if you have been investing for more than a decade, I think you know this yourself. And whenever you are taking, you are well understood about the risk which would be there in the market. Another thing is, it's very much prevalent now is, people hear about returns which are made by people, by friends and the close family, and they get very overexcited about those returns, and they jump into equity investing. We call it FOMO in the market, fear of missing out. Look, 2-3 things which plays here, and this is the case across the board. You will always hear about the success story. Even when I will go and talk with my friends, look, I thought about this idea 2 years back, and this is the return which we have generated. There are lower chances that I will go and say this was a stock idea which I found 2 years back and it didn't work very well. So we have to cut down our position. So you always hear about the success part of the story. So one thing is this, number of shares you are buying, but you have to think about the return on the amount of investment, the percentage return on the amount of investment. It doesn't matter whether you buy 100 rupees stock or a 1000 rupees stock or a 10,000 rupees stock. What is the potential upside in percentage term is relevant for you, and you should always be focusing on that. Um, and other thing is, to how I made up my mind to move from a low price stock to not thinking about that when a high price idea come to my mind is, something like, say if the company is quoting at 10,000 rupees or 5,000 rupees. So think about this, that a company which is quoting at 5 or 10,000 rupees, normally in India the face value of the company is 10 rupees or even lower. So they must have suffered in so much years earlier to command that 5,000, 10,000, if they haven't done any kind of split and not those things. If they have done the split and bonuses, that's a different story. But when you see anything which is a high price stock and you believe that from here the upside is not very high, it's a very wrong way of thinking, and this is most prevalent among retail investor, I would say. So build your conviction and see the return potential, because your amount of return will be dependent on how much you have invested and the percentage return. The price entry point will not be that relevant. Other thing I want to add is, this we discuss also when we talk about buying in tranches. This is something I don't remember, but this must be advocated by Warren Buffett also. What they say is, uh, he always say that I build my position. But when he say building his position, it doesn't mean that buying something at 1,000, then adding at 2,000, then adding at 3,000. I'm sure he is not the guy who follow the price. What he follows more is, when I bought this company, this company was available at 30, and the growth potential for next 10 years was 20-25%. Now the stock price has moved to follow these simple behavioral aspect. uh, you would be I won't say that you won't make mistake. Making mistake is the part of the investment journey, but I assume that the amount and the intensity of the mistakes which we make will come lower. uh, One thing, though this was not the part I didn't thought of discussing this, but something which is happening in the current market, where SEBI also sounded off, that there is too much amount of activity on the derivative side. One thing is, I'm not an advocate towards derivative or against it, but one thing you should follow is, if you are at least, again, as I was saying earlier, that if you are practicing investing on your own, you should be invested for at least good amount of 5 to 7 years at least before trying full fledged on your own. The other thing is, you should have invested equal amount of time understanding the market before dwelling into derivative. What we are seeing among the youngster right now is they are directly starting with the derivative. Other thing which you should be cautious of, the outstanding position in derivatives should not be more than 15-20% of your portfolio. If you are starting new, if you are long term in the market, you understand the derivative position, you understand the volatility. If you're buying something where the VIX or the implied volatility of stock or the underlying index is already very high, you don't need the leverage to top on that. So those aspect is fine if you have invested good amount of time in the market. But if you are someone new who have started investing, who taste earlier success in the world of investing, I would say that derivative you approach with caution, because the return or the downside, both side are magnified in the world of derivative. And when you already have higher volatility, which is not there in the market right now, but if you have a higher volatility, derivative people use either for hedging or for having a leverage. If you have higher volatility, so you shouldn't be you shouldn't be over leveraging by the usage of derivative. That's pretty much I was thinking about this discussion. One thing is there that people make, what mistakes generally people make is, they spend a small amount of time in the market with a small money. They made decent return in bull market, and they feel that this is the game which can easily be replicated with a large quantum of money. So you shouldn't. That's where, again, as I was saying, I started with greed and fear. I'll end our discussion with some discussion on greed and fear. Is you extrapolate that small capital work on a larger capital, there the greed is very much heavy on you. What happens is, suppose your wealth is, I'm just saying for example, your wealth is 10 lakh, and you invested on equity side, direct equity investing on your ideas 1 or 2 lakh. It moves up 10-20%. It is not very much material change on a level of your entire portfolio. So whenever there is a drawdown, there is volatility, you would be happily embracing that volatility. But if your portfolio is 10 lakh and you invested on your research idea entirely in 1 or 2 ideas, 8, 9 lakhs, and then you see the bout of volatility. It might not be, I'm saying that stock goes down, but what happens is, suppose something goes up 20% and then it fell by 10%. You were making 2 lakhs gain on that, on your investment idea. Now that gain is fallen to 1 lakh. That itself will, why I again and again say that this perception of, or as an investor, this reading of greed and fear, whether the market is very greedy or whether the market is very fearful, is very important for every investor. Is because this emotion or this behavioral aspect of investing hasn't changed in last 30 years, and this will not change in next 20 30 years. And if I become more philosophical, say the core behavior of mankind, love, envy, anger, uh, surprise, those hasn't changed in last millennium also. Even those emotions were there with us even before we started speaking, and they will continue to remain with us. So nothing like that, it will change. Similarly, the greed and fear, it works in cycle. When you're a bull market, you're overbought by the greed philosophy. In a falling market, whenever it comes, and normally everything happens in cycle, as I was explaining. That time you should be having some amount of dry powder to invest. When we say dry powder is having some amount of liquidity. If you are a service guy who constantly gets salary, then you have some amount of saving which will accumulate in 2 3 months time, 4 months time. So you can park your investment, you can wait for fairness in the market and then invest. If you are business owner also, then also what happens is, there is a bout of liquidity in your businesses where you generate profit. You wait for that profit to be deployed in capital market. But if you are 100% stock market investor and your entire capital is deployed here, then having dry powder is important, because your core income is stock market, capital market, and this is from where you earn your living and everything. So having some amount of dry powder which can be deployed during volatile time is important. It can be either through a liquid instrument or some kind of debt instrument, whichever way emotionally you are comfortable. Look, investment is all about where you find your comfort. Every person is different behaviorally, how they tackle the downtime, how much cushion they want in terms of liquidity. So understanding your behavior is very much important in investing. I'll take a pause here. We have thought of running a small quiz. So I'll take a pause here, and so I hope you have listened and will participate in this small quiz.
I must say it was a very much enlightening session. Uh, Meanwhile, if you have any questions, you can put your questions in the comment section and we'll answer them. And just to answer the quiz, the first question: should one limit allocation to single idea stock? The answer is limit allocation to 10% in 10% in single stock. To answer the second poll question, for diversification, what is ideal number of stocks in portfolio? So we said 15 to 25 stocks can be the diversification of stocks in portfolio. And the third is, it better to buy everything at single? So you all guessed correct. We should not buy in a single stock. We are waiting for your questions. Please put your questions in comment section. So we'll conclude today's session. So as we conclude, I want to express my gratitude to each and everyone for your continued participation in Yes Win Pulse. Let's make today's webinar another enriching experience as we dwell deeper into the world of finance. Thank you once again for being part of this journey, and let's uh, stay tuned for such informational session. Thank you.